Hello everyone, welcome to today's webinar. The topic we'll be covering today, buy-to-let, brokers and Brexit. I don't have a crystal ball, we don't know what's going to happen in the future, but what we thought we'd cover today are a few little bits and pieces that we're seeing happening in the market, which may help you when you're dealing with your clients, as well as a recap of the tax changes that have happened recently and what your clients will be seeing happening to their bank accounts over the next few weeks. So first of all, a little bit about who are Crystal Specialist Finance. We're still a family-owned business. We've been running now for about 40 years. We've got over 80 lenders on panel across our 6 business areas. And because of the volume of business that we do get exclusive and semi-exclusive products and lenders that we can make available to you. We are dedicated to the intermediary, which means we offer training, BDM visits, and ongoing case management and handling. And we are multi-award winning with over 200 years collective experience within the business. And there's a few awards there that we've won. There's a few more that you'll be seeing emails from us asking for your votes over the next few weeks as well. So what we're showing there is that we are dedicated to you, the intermediary. We have been around a long time. We plan to be around a long time more. And it's all about doing things the right way. It's about making the specialist market crystal clear. To back that up, this is our 2019 charter. We're passionate about specialist finance. The people. You have placed yours and your customers' trust in us. So we need to deliver. We need to talk to you to provide updates on cases and not just hide behind a computer says no approach. We know we're only as good as the last case you did with us and we want your next one. So therefore we need to assist and support you throughout the life cycle of that loan. Speed, service and flexibility are the core mantras of our business. We need to provide you with updates on what's happening out there in the market. We need to provide you with webinars such as this and other materials to ensure that you're one step ahead and that you spot the opportunities that your clients are presenting you with. For us, specialist finance is straightforward, it's what we do. However, for brokers that don't do that very often, it can appear daunting. So not only will we assist you with your current cases, we'll show you the opportunities that are already there in front of you to find new ones. Transparency is important to us, so we have no hidden fees. We want to make things nice and simple. So all fees will be discussed, agreed up front, so there are no hidden surprises later down the line. And look, we know that occasionally cases will hit problems, so we proactively try and fix that for you. If we can't, we'll provide an alternative option, an alternative lending solution, and we communicate that very quickly. We pride ourselves on our technology. We've revamped our broker portal. We're working on a few new initiatives for 2019 which should be game changing. But for us, it's not about hiding behind that technology. It's how can we utilise technology to get things done better, quicker and easier for everyone. And we are experts in our field. This is what we do. We don't sell insurance, we don't do pensions, we don't do equity release, we do specialist mortgages. That's what we're good at, that's what we do, that's what you should be using us for. So, buy-to-let market. There's a new story coming out every day at the moment about what's happening to buy-to-let, the end of buy-to-let. There was one recently about the buy-to-let bubble bursting. Buy-to-let feels like it's been attacked now for a number of years, going back to 2016, stamp duty change imposing the additional 3%. 2017, the PRA changes, tax relief, the strength of the pound affecting overseas borrowers. 2018, stage 2 of the tax relief kicked in. HMO changes at the back end of last year with mandatory licensing. And then the HMRC change to moving most landlords across to a cash basis, which we'll come across shortly. And then this year, Brexit. Who knows what's going to happen there? Tax relief, stage 3 kicks in. And cash basis will take effect when people start filling in their tax returns. And into the future, the final stage of the tax relief happens in 2020, and who knows what will happen beyond that. But let's start with Brexit, the elephant in the room. And the truth there is that no one knows what's going to happen. Even the decision makers at the moment don't seem to be able to decide on the path and the plan that we're going to take. And what does that do? It creates uncertainty. What's going to happen to house prices? What's going to happen to the debt crisis for the UK? What's going to happen to lender liquidity? We've seen a few lenders pull out of the market over the last few months. Will that continue to happen? If we remember back to 2008, 2009, there were lender crashes weekly. And what's going to happen with house prices? Are they going to fall? Are they going to hold? Is it the right time to buy? Isn't it the right time to buy? The uncertainty is the problem at the moment. We're seeing valuations where the value is commenting in there that they can't rely on the figures in the report for very long because they may have to revisit them should anything happen. The strength of the pound. Again, that creates an opportunity. If you look at London, for example, many properties in the capital are owned by foreign investors. Will the changing strength of the pound grow that? Will it mean less investors are available, these properties are back on the market? We're already seeing the high value properties in London falling in price. Apparently it's never been a better time to buy a property over £5 million. So this does mean there are opportunities out there. If people decide to leave the market, if we get landlords selling properties, for example, a reduction in house prices could mean increased access for first-time buyers, which therefore opens doors for residential buy-to-let mortgages. Bridging finance, where we're looking at undervalued properties, or even more access to commercial properties. Looking at the high street, for example, it seems to be that retailers are closing down weekly. More space, might be more opportunities there for investors to be purchasing these commercial units. And as we've talked about in previous webinars, commercial property does have a higher yield, and it can be a really good income generator for buy-to-let landlords. Those that don't want to exit, maybe it's not the right time to sell, or they can see the opportunities for them in the market by holding on to properties. They want to improve them. They want to create more wealth from that asset, which opens up opportunities for second charge loans, bridging finance, or refurb and development. We'll come on shortly to a few case studies where we've looked at these opportunities and really added value to some of our clients' portfolios. So a quick recap on buy-to-let. Obviously one of the first changes that came in was the 3% levy for landlords. If you're buying a second property, you now pay 3% more than if you're buying your first. You only have to look at the number of new purchases in buy-to-let to see the impact that this has had. Tax regime changes. Mortgage interest relief was cut for individuals from April 2017. This will continue staggered up until 2020. So landlords could no longer deduct all of their finance costs from income and pay tax on what's left. Now it works the opposite way. Now they have to pay tax on the full amount rather than the amount that's left at the end of it. So that came in from April 17. So end of tax year would have been April 18. People are now starting to fill in the tax returns, which explains why we're seeing all the stories at the moment about the end of buy-to-let. All it is now is people that maybe didn't plan for this, people that maybe buried their head a little bit and thought it wouldn't impact them, now start to see it in their pocket. So now people are asking questions, and now people are looking for options from there. Is limited company the right thing to do? Is exiting the market altogether the right thing to do? There's an example there of the situation previously. So if we take 2015 to 16, income of 8,000, wear and tear of 8, which could be deducted, loan interest at 36, which could be deducted, leaves a 36k taxable profit. If you were taxed at 45%, you pay 16,200, which leaves you with a profit after all of that 27,800. By the time 2021 comes around, you pay tax on the full 80,000, which therefore increases the landlord's bill by £12,600. A year ago, there was a lot of talk about limited company buy-to-lets. Is this the right thing to do? Because if you are a limited company, you can still offset all of that and you only pay tax on the profit as you would do with any company. However, it might not be the best thing to do. So we had an influx of applications and inquiries at the time, with investors thinking that this is the right option for them. However, there are costs. If you take a property at 250,000 when it was bought in 2001, let's say it's worth 1.1 million now, because it's a purchase by the limited company from the individual, there's a stamp duty implication. In this case, 85,550. Because it's been sold by an individual, there's also a capital gains tax liability there as well, which in this example, 235,000. So therefore, it's going to cost £320,000 to transfer this property into a limited company, just on those two taxes, ignoring legal fees or professional fees or anything else to go on top. In addition to that, limited company rates are a little bit higher. Not much, but they are a little bit higher. So therefore, is it the best thing for your clients to be doing? It might be, because borrowing through a limited company, the limits on mortgage interest relief apply only to individuals. The company can still offset mortgage costs. You can retain profit within the company for reinvestment. Corporation tax is lower than the personal tax rates, and then dividend tax means the first 2,000 that you receive is tax-free. From our point of view, it's really important that your clients are getting the right advice on this. Now, we're not tax advisors. All we can do is put the options there. So we recommend all of your clients that are considering this, speak to their accountant, get some advice on which solution is best for them. Whichever way they want to proceed, buy-to-let is still an attractive proposition. It still works. It just now, more than ever, needs to be planned. PRA changes impacted the market. Now lenders need to review a full portfolio. They have to look at background properties. Are there any risks there that the lenders need to be aware of? What kind of products do they have? How highly geared is it? What's the personal income position? Does it work? Does the business make sense? So some lenders decided just to pull it all together. Some lenders took the view that they would only look at private landlords, those with under 4 properties, because a lot of these changes only apply to professional landlords. Some lenders split their process. Everyone took a slightly different approach to how it was done. But that was a taster really of things to come within the market, that buy-to-let is no longer seen as an accidental thing that you fall into. Parents pass away, leave a property, I'm going to keep that as an investment. It now needs to be looked at as a business. Is it sustainable? Does it work? Does it make a profit? The demographic of customers has changed substantially. We've got the onset of landlords, portfolio landlords, limited companies now entering the market. Overseas borrowers, expats, limited companies are all still available, and more people are becoming self-employed. This is the new normal. 10 years ago, a 79-year-old wanting to hold buy-to-let properties is something that was unheard of. Now, it's something that we see regularly. People don't want to exit the market just because they reach a certain age. And therefore, as advisors, we need to adapt. We need to make sure that we are familiar with these products, with the solutions that are available for us. Gone are the days where we could just be a vanilla mortgage company just turning over standard remortgages at 60%. Now, we need to be looking at all of these opportunities. Otherwise, we're turning away clients, we're turning away income, and we're not able to help. For us, it's about finding that solution. It's about making sure that we can deliver on what our customers want us to. Can we find a solution to all of these problems? Here's an example. 79-year-old lady who was living in Florida, had a very small mortgage on the property. Buy-to-let had come to an end, needed to be repaid. So she'd got rent coming in of $1,300 a month. Original plan was to sell the property at the end of the term. She didn't want to. It's generating nice income for her. She's quite happy. Can we help? Well, yes. We've got lenders that will do that deal. We gave her a 10-year loan, pound for pound remortgage, interest only, and this completed in 2 weeks. We had a client wanting to move properties from an individual to limited company. 26 properties in the southeast, valuing 14 million. Client needed to borrow 7. We needed to do the whole portfolio transaction at the same time because they've been advised that they could benefit from incorporation tax relief, which we have covered in previous webinars. This completed in 8 weeks at 2.7 over LIBOR, 1.5% arrangement fee, and we paid the broker 1%. It's not a bad deal. On top of that, the introducing broker was also free to complete all of the insurances on those properties. Obviously now they're in limited companies, different insurance policies were required, etc. So a very lucrative transaction. And in this situation, moving those properties into a limited company made perfect sense for the client. The cash basis. So from 2017-18, the default basis for most property businesses is now cash, as opposed to it being accruals, which you had a choice of previously. The main difference there, tax is only paid on the profit you receive, rather than it being paid on profit on cash you haven't yet had. So this mainly affects commercial landlords, where rent might be paid in lump sums or upfront, where it didn't need to be apportioned now over the year, which it needed to be done previously. Whereas now you receive it, you pay it, that's simple. But again, it's another change for property landlords. It's something else for them to get their head around. It's something else that they'll need to speak to their accountant about. So again, it just backs up this point that property is now a business. Property isn't just a hobby or something you can have a dabble with. So a little bit earlier I touched on the refurb costs. Shawbrook have got a really good product at the moment which forward funds refurb. So with this one, 75k purchase price, end value of the property once a bit of work had been done to it was 110, which was confirmed by the valuer. And we managed to secure 75% of purchase on day one, plus work costs, to enable the client to do that. Benefit there, the client can stay with the same lender, get a reduced interest rate on the exit loan. The bridge completed in 4 weeks, the work was done, he's now applied for an £82,000 buy-to-let loan, which again is another capital raise that he can do there and go on and do this again. Most refurb products need you to spend the money first and then get that back once you do the exit. Whereas this particular product, as long as the works are small, they can be forward funded. Again, another example of how a specialist solution can fix a problem that your client might come across. So Precise Mortgages have a bridge to let product. So with this one, work needs to be paid by the client. The valuer goes out, assesses the property as is, reviews the work that's due to be carried out, and gives an end value as well. So, dealt with by one underwriter, Precise will look at that and issue 2 offers. They issue a bridging offer and they issue a term offer. Once the work's done, simply a phone call, get the valuer back out, which has already been paid for. The valuer confirms the work has been done, his previous valuation stands, and then funds can be released on the exit as well. The first case we did on this, 17 working days start to finish. The client, so this was done just before Christmas, the client has finished the work, the valuer has gone back out, confirmed everything was fine with it. He actually stated the property is expected to bring in £1,300 a month rent instead. Perfect solution for the client. We're now doing a 75% buy-to-let takeout on that, which is in legals at the moment, ready to draw down. Great product for the client. He's now got capital back. He can go off and do this again. Second charge. It's not just first charge options that we can look at. So we were looking at replacing a second charge that was already on a property in order to pay a tax bill. 95% loan to value, overdue tax bill from previous years. The profits in the business weren't brilliant. We managed to get that deal done. 18.9% interest rate, so not the cheapest loan you'll ever see, but it's about finding a solution. There's a whole spectrum of products, rates and lenders out there, and at some point your client will find the solution they're looking for. With this one, the need to get that done, the need to get that paid was essential. Priced it up, the figures worked, so the client was happy to proceed on that basis. So, looking to expand a buy-to-let portfolio. Client owned property in the southeast, wanted to buy more. So he'd seen all the press that the north of England had greater yields, cheaper properties, so therefore he wanted to buy 4 properties. HMO, buy-to-let, new build flat and a flat above a shop. A number of lenders the broker had approached had different issues with it. The distance, how would he run properties that were a couple of hours drive away from him? He got no experience at running the particular properties he was looking at buying. The values, they were all relatively cheap properties. So we got a commercial lender involved. They did the whole portfolio, all 4 on one loan, 3.89% on a 10-year interest-only mortgage. The benefit there is that most commercial lenders take a more manual approach to underwriting. So rather than just popping it into a computer and seeing what comes back, they look at the deal in front of them. They read the credit report, they read the valuation, they read the client's business plan. So with this one, they could see that he had done his research. He did know why he was entering each of these markets, why these particular properties were good, and they considered it a sound asset. Therefore, happy client, happy broker, let's get the deal done. So we've got a number of exclusive products available to us at the moment that you can use to solve problems that your clients are looking at. So these are just 4 of our sectors currently. So bridging, rates there from 0.49 on some exclusives that we've got. Forward funded refurb at Shawbrook at 0.8, the Masthaven commercial bridge, the Precise refurb starts from 0.49 and they're together at 0.49. Buy-to-lets, together buy-to-lets there at 5.79. Masthaven looking to lend to HMOs and limited companies from just 3.14. Through Crystal with Pepper Money, you get a discount on the buy-to-let rates of up to 0.9%. And then we've got 2 relatively new products, which I'll come on to shortly, from Zephyr Home Loans and Atom Bank. So on the residential side, again through Pepper, you get a 0.25% discount. On certain products there are lower fees, enhanced loan to values. Together have a really good 2-year fixed rate at 3.59 and Magellan 2-year fixed rate at 2.74. So hopefully looking at those rates there, specialist isn't scary. If we're talking about buy-to-let rates from 2.69, residential rates from 2.74, they're not a million miles away from the mainstream market. And then on commercial, together 6.99, Atom Bank start from 3.5, Interbay 4.15, and you can get access to Shawbrook's trading business range through Crystal at 5.85. So the Zephyr product range, new lender to market, really good traction on their products currently. Up to 80% loan to value, 2-year fixed from 2.69, 5-year fixed from 3.26. They've got a very comprehensive product range which includes no product fees on certain products there as well. They will do income top-ups or top slicing, as you may well have seen. Maximum age, 95 years at the end of the mortgage term. So again, looking at the landlords, looking at the older landlords, we've got solutions there. It's a standard buy-to-let range, but they will consider HMOs up to 6 bedrooms. They will do multi-unit blocks with up to 6 properties in it. They will do flats above commercial. They will do ex-local authority, deck access. Loans go up to 2 million, and you can have as many other buy-to-lets in the background as you need. Minimum property value is 100k on HMOs and 75 on standard, and they will look at minor adverse as well. There's only a handful of companies that do have access to this product, so please pick up the phone, speak to our guys here and see if we can get your clients some solutions through this product. Then through Atom, package are exclusive on their portfolio buy-to-let, up to 80% loan to value. Rates from 3.7%, under 850,000. For the larger ones, the rate creeps up a little to 4%. But with these products, no early repayment charges. So this is aimed at your more professional landlord between 4 and 25 properties. They will look at lending to limited liability partnerships or limited companies. And terms there go up to 25 years. And with this, there are things like AVM options as well, if we can do desktop valuations and things like that. So we've got the Zephyr option for your standard landlords, but the Atom Bank option for your commercial portfolio-driven landlords. So hopefully that's been useful. Quick overview of where the market is, where it's been, potentially where it will go, dependent on what happens over the next few weeks, months. And hopefully you've seen some solutions for your clients in there as well. The key message, if you take one thing away from this, let's find a solution. We've seen most scenarios before, and if we haven't, we're quick to learn. Let's find the problem, let's fix it, let's get the solution for you, for your client, and let's all do business. Contact details are on there. If you have any questions, please get in touch with us. If you want to discuss a deal or a scenario, please contact us there. Website, email, phone, whatever's easy for you. And look out for future instalments where we'll be touching on more topics and will hopefully keep you abreast of what's happening within the market. Thank you for your time. Goodbye.